Chapter 18, Ifers. Now, when Ifers first rolled out for the CPA exam, everyone was like, oh my goodness, And it was kind of a big deal in the accounting profession because we thought, okay, we're all going to be shifting to Ifers eventually. It's not if, but when. Well, due to convergence, the differences between GAAP and Ifers are getting smaller and smaller. So while, yes, you need to know Ifers differences for the CPA exam, I don't think it's a topic that you need to freak out about. And just be comfortable with it, and you'll be good. So let's start with the basic accounting concepts under Ifers. Ifers is governed by the International Accounting Standards Board, the IASB. And Ifers standards are the most authoritative in the hierarchy and is the first place management looks for guidance on recognition and accounting policies. The IASB framework helps to develop Ifers standards, but the framework is not a standard itself and does not supersede any standards authority. That could be a good exam question. The objective of the IASB framework is to provide users with information. That's pretty straightforward. An assumption with Ifers is that the entity uses the accrual basis of accounting. There are two qualitative characteristics of Ifers. They are relevance and faithful representation. Financial information is relevant if it helps the user to make decisions. And under the umbrella of relevance is predictive value. They help the user to predict future trends. And confirmatory role. They help the user to confirm what happened in the past relative to what trends were predicted. Faithful representation is pretty straightforward. The financial information is an accurate depiction of what is really going on within the company. Now, included in faithful representation are completeness, neutrality, and the information is free from error. So to recap, the qualitative characteristics of Ifers are relevance and faithful representation. And under relevance is predictive value and confirmatory role. And under faithful representation are completeness, neutrality, and free from error. Next are the enhancing characteristics, which are comparability, understandability, verifiability, and timeliness. And you probably already know these, but comparability allows the users to compare different financial statement items across various periods. Understandability refers to the information that is presented in a way that's easy to digest and understand. Verifiability means that you and I would both look at the information and reach the same conclusion. And timeliness. If it's timely, then we can use it to make a decision in time. If it's 6 months late, it's of no use to us. Now, the pervasive constraint for financial information presented using Ifers is cost versus benefit. So reporting financial information is very costly. So the benefit of reporting an item in the financial statements must outweigh the cost of including it in the financial statements. Recognition for balance sheet and income statements under Ifers. First, they must meet the criteria for an element. What's an element? Elements are assets, liabilities, equity, income, and expense. Again, assets, liabilities, income, expense, and equity. Second, they must meet the criteria for recognition. There must be a probable future economic benefit that can be measured reliably. If the value or the outcome cannot be measured reliably, Ifers requires the use of the cost recovery method. And if you think back to the previous chapters, the cost recovery method is the most conservative method of revenue recognition. You don't start recognizing revenue until you have recovered all of your costs. So the money's coming in, and we don't recognize the revenue until we have recovered our costs. So if under Ifers, if it can't be measured reliably, we have to use the cost recovery method. It's most conservative. So I mentioned that the differences between Ifers and GAAP are getting smaller and smaller. Well, here are the differences that remain. Under Ifers, so these are required under Ifers, but not GAAP. Under Ifers, comparative statements are required. Under Ifers, the completed contract of revenue recognition is not allowed. Under Ifers, no LIFO. Under Ifers, a statement of comprehensive income is required. And under Ifers, a statement of changes in equity is required. Additionally, Ifers uses the term income instead of revenue. So I said revenue before. It's actually income. Under Ifers, they use income instead of revenue. And under Ifers, gains are not displayed separately, and losses are treated the same as expenses, but are displayed separately. And Ifers does not use net income, but rather the word or the term profit. So again, under Ifers, Ifers requires comparative financial statements. Ifers does not allow completed contract. Ifers does not allow LIFO. Ifers requires a statement of comprehensive income and a statement of changes in equity. Ifers uses income instead of revenue and profit instead of net income. Under Ifers, gains are not displayed separately, but losses are. So when a company transitions to Ifers, you have what's called the date of transition. And the date of transition is the first reporting period that an entity produces full comparative statements using Ifers. So if Ifers was implemented June 2010 for use in the December 31st, 2010 statements, then the date of transition is actually January 1st, 2009, because a full year of comparative statements is required from the previous year. Why? Because Ifers requires comparative statements. You will recall the qualitative characteristic of comparability that we just covered, which requires comparative statements from the previous year. For property, plant, and equipment, the fair value election is the most efficient method for converting assets to Ifers. And I want to back up again. Let's go over the date of transition again. If Ifers was implemented June 2010 for use in the December 31st, 2010 statements, then the date of transition is actually January 1st, 2009. Now, I know I'm using old dates, but it doesn't matter. Just pretend like the company, like this is historical. So the date of transition is January 1st, 2009, because you have to have a full year of comparative statements. So moving on, again, for property, plant, and equipment, the fair value election is the most efficient method for converting our assets to Ifers, because we are transitioning to Ifers in theory, assuming that we wanted to. We are transitioning our assets to Ifers, so we have to use the fair value election. It's the most efficient method for converting the assets to Ifers, because adjustments to asset values made for adopting Ifers get made in the entity's retained earnings or equity. Current assets and liabilities under Ifers. Current assets under Ifers don't have any noteworthy differences from their treatment with U.S. GAAP. Current liabilities, however, are different. Current liabilities can be refinanced into a non-current liability, so going from current to non-current, if the refinance agreement is executed before the balance sheet date. GAAP only requires intent to refinance, not execution. GAAP, intent. Ifers, execution. Contingent liabilities. Contingencies are uncertain future events. So GAAP has three classifications for contingent liabilities. They are probable, reasonably possible, or remote. Ifers only uses probable and measurable. So for contingent liabilities, GAAP, probable, reasonably possible, or remote. Ifers uses only probable and measurable. So both GAAP and Ifers have probable, but Ifers gets rid of reasonably possible or remote and just uses measurable. Okay, this next section is newer, and I think it's ripe to be asked on exam day, so please pay attention. Financial assets are recorded on the statement of financial position using one of three methods under Ifers: amortized cost, fair value through other comprehensive income, and fair value through profit or loss. Let's go over each one of these three. Amortized cost. It's recorded using amortized cost if the objective of the financial asset is to collect cash flows, and you use the effective interest method. Now you record an asset using fair value through other comprehensive income if the objective is to sell financial assets and the gains or losses are recognized in other comprehensive income. Finally, you record on the statement of financial position using fair value through profit or loss if the objective is everything else except the two that we just talked about, and the gain or loss is recognized in profit or loss. So let's recap. You have a financial asset. If the objective is just to collect cash flows, then you use amortized cost and the effective interest method. If the objective is to sell the financial asset, use fair value through other comprehensive income, and the gain or loss goes where? Other comprehensive income. If the objective is anything else, use fair value through profit or loss, and the gain or loss is recognized in profit or loss. All right, moving on. Deferred taxes under Ifers. Deferred taxes use the liability method, and all deferred tax liabilities must be reported, but only probable deferred tax assets can be reported. So all deferred tax liabilities are reported, but only probable deferred tax assets are reported. Deferred tax assets and liabilities are non-current on the statement of financial position and can be netted only if they are related to the same country or taxing authority. So for instance, a China deferred tax asset can't offset a Japan or Japanese deferred tax liability. Tax rates. Ifers uses the enacted tax rate or the substantially enacted tax rate. GAAP uses the enacted tax rate only. The income statement under Ifers. The income statement includes income, financing costs, tax expense, discontinued operations, and profit or loss, as well as any non-controlling interest in profit or loss and any net profit or loss attributable from equity. Let's go over that again. The income statement includes income, financing costs, tax expense, discontinued operations, profit or loss, and any non-controlling interest in profit or loss and any net profit or loss attributable from equity. Something new under Ifers is Ifers allows the equity method for investments in subsidiaries. So investments in subsidiaries can be valued at cost, fair value, or the equity method. Make sure you know that. Fixed assets under Ifers. Property, plant, and equipment is recorded at cost and then valued using one of two options: the cost model or the revaluation model. The cost model is where the asset is carried at cost less accumulated depreciation and impairment loss. Under the revaluation model, the asset is adjusted to fair value less accumulated depreciation. So you record it at cost and then you value it to fair value. Under the revaluation model, increases in value from the adjustment are reported in the current income as other comprehensive income. Decreases in value from the adjustment are treated as an expense. In order to use the revaluation model, the asset must be able to be reliably measured, and the model must be applied to the whole class of assets, not just one asset. So again, under the revaluation model, upward adjustments go to other comprehensive income. Downward adjustments go to expense. Investment property under Ifers. It does not include property used in the course of business. Investment property is initially recorded at cost and then revalued using one of two methods, the fair value model or the cost model. The fair value model is where the property is revalued to fair value and the profit or loss goes to the income statement. So we just covered property, plant, and equipment. So note the difference where the adjustment goes under Ifers. For an investment profit or loss, it goes to the income statement. For property, plant, and equipment profit or loss, it goes to other comprehensive income, because under the revaluation model, when you write the asset up, it goes to OCI. When you write it down, it goes to expense. So for investment property, the profit or loss goes to the income statement, whereas property, plant, and equipment goes to other comprehensive income. The second method is the same as property, plant, and equipment. It's the cost model, where the investment is carried at cost minus accumulated depreciation, but the fair value must be disclosed in the notes to the financial statements, however. Moving on to intangible assets. Intangible assets under Ifers are valued the same way as property, plant, and equipment, either the cost model or the revaluation model. And just to recap one more time, if under the revaluation model, if you write it up, it goes to other comprehensive income, and if you write it down, it goes to expense. And the revaluation model must be applied to the whole class of intangible assets, not just one. Now, what about internally generated goodwill that is not recognized under Ifers? Amortization of intangibles. If the intangible asset has a finite life, it's amortized over its useful life. If the intangible asset has an indefinite life, you don't amortize it. Rather, you test it for impairment. Leases under Ifers. If the substantial risks of ownership have passed to the lessee, then the lease must be accounted for as a finance lease. Operating leases can be recorded as investment property if they are measured at fair value. And it's important to reiterate that if one asset uses the fair value model, all other investment property must use it as well. Pensions. Under Ifers, defined benefit plan must use the project unit credit method, which calculates the present value of the defined benefit obligation. So under Ifers, defined benefit plans use the project unit credit method. Finally, the statement of cash flows under Ifers. Interest expense and financing costs can be classified as either operating or financing. But once a classification is chosen, all future costs must be classified there. Additionally, any significant non-cash transactions must be included in the notes to the financial statements. This concludes Chapter 18.